Hi, this is David Zai, Mortgage Guy, and today I'm going to take you deep into the secret world of mortgage refinancing. Ever wondered how you can save thousands of dollars on your mortgage without breaking a sweat? In this ultimate 2024 refinance guide, I'm going to show you how, so stay tuned as we unlock my ultimate refinance guide for you in 2024. So what is mortgage refinancing? That's actually the first question that we have to understand, and why are we doing the mortgage refinancing? Mortgage refinancing is where we're altering the loan terms to benefit the consumer financially. So when you refinance, there's a lot of things that kind of go into it. You have to decide what you want on the refinance. Do you want cash out? Do you want just a simple interest rate reduction? And then at that point, once you kind of decide which refinance route you'd like to take, we then have to decide whether you want one mortgage or two mortgages, right? So if you refinance the first mortgage to combine everything, that's beneficial to you if the blended rate is lower on the refinance versus whatever you're refinancing currently and all of the debts. If you have a super killer interest rate on that first mortgage and a home equity line would make sense, let's say you have a really high credit score and you only need to access very little funds, at that point, I would recommend you get the second home equity line. After you make that decision, we really have to then look at the benefits of what refinance does. Paying off consumer debt can certainly increase your credit score. You can do home improvements. You could take that money and you can reinvest it. Those are probably my top three options. And later on in the video, we're going to give you some real life examples of how this savings has transformed many lives. A couple decisions that you really have to make is, number one, we have to figure out with the refinance, you're resetting the amortization again. We've often talked about what is resetting the amortization. Okay, so the first thing we want to realize is with the amortization chart, which is right here, when you first start your mortgage, you're paying on that mortgage and you're paying very little principal and a lot of interest. As you pay through the years, you're paying more principal reduction. However, you're paying at a higher interest rate. When you refinance, that term starts all over again. And even though you're starting out from scratch and paying very little principal and a lot of interest, you have to look at how much interest you're saving, right? A good way for you to compare is you look at your closing disclosure that you were issued at closing, and you look at how much interest that you would pay over the life of the loan. And it'll show on a closing disclosure, okay, in the APR section. At that point, you then look at your amortization chart that you received when you closed, and you say, look, I closed my loan in March of 2020. We're recording this in March of 2024. So now we're like 4 years down the line. We want to look at how much interest we have paid from the last 4 years and make sure it is in line with our current principal balance on the amortization chart. At that point, you could deduct out all the interest that you've paid and you look at how much interest you would have remaining on your current loan compared to the new loan. And that's really a good way of formulating whether a rate term refinance makes sense. Notice I said rate term. Now, if we're getting cash out and let's just say we're paying off debt, this is a really good activity to see if this makes sense for you. We want to look and say, okay, if we're taking cash out and we're going to take $100,000 out, I'm going to use $80,000 to pay off my consumer credit card debt. At that point, we would want to take the blended rate of all the credit cards that we're consolidating. And most credit cards are going to range anywhere between 9% on the low side and maybe even some promotional zero payments, but those are typically higher payments, to even like high 20s and 30s. With those, when you blend those rates together and you look at it, you say, look, I've got $150,000 left on my current mortgage. I'm pulling $100,000 out. My current mortgage at $150,000 is only in 3%, but I need $100,000 to pay off this consumer debt. When you look at the blended rate, depending on where that all stands, it could make sense to add everything all together because there's two things that you're going to achieve by doing that. Number one, you're going to eliminate all the consumer debt that you want to get paid off. When you eliminate all that consumer debt, you eliminate the monthly payments and you eliminate the interest rates as well. When you do that and you combine it all into, let's say, a 7% interest or a 6% interest, at that point, you now have more cash flow that you've opened yourself up to accessibility. And the second thing that's really important that you have to understand is it's really going to improve your credit score. Because when you eliminate all that consumer debt that may be over 50%, 60, 70, 80, even 100% utilization, you are now freeing up that utilization, and hopefully you don't use it too much and you keep it down below 50%. And at that point, from everything reporting that it's paid off, and it can take up to 60 days for it to show up on your credit report, all the way through the end of your mortgage, you now have opened up accessibility, you have access to more funds, and any type of financing that you get in the future is definitely going to save you money. Now, the third reason that people want to do cash out refinances is to maybe do some home improvements or send their kid off to school, right? Or a wedding. There's a lot of different reasons that people want to refinance, but let's just say it's for home improvements, okay? And this is why home improvements are always good. I'll use my personal story. When we sold our house, our last house, we never fixed up the house. We bought it as a semi-new construction. The house was built 3 years ago. They didn't have anyone really in it till like the third year, so it was only occupied for a year. But by the time we moved into it, it was like basically 1 year old. At that point, we really didn't make the improvements that we wanted because we were like, we're not sure we're gonna stay here, and let's just wait till we sell the house before we make any major improvements to increase the marketability of the house. At that point, my wife and I, we did it about 2 months before we moved out of the house. We did all the improvements, repainted everything, put a beautiful horse fence in the backyard, a lot of different things that we did that really made the curb appeal increase significantly, right? So we never got to enjoy those benefits. However, we think back now, the house that we're currently in, we, instead of doing that at the last minute, we did all the improvements up front. So, the last 6 years that we've lived in our house, we've actually had the opportunity to enjoy all the improvements. We keep our stuff really well, so everything's clean, everything still looks good, everything's still semi-modern. So, we got to enjoy everything, and I know with that equity and that work that we put into it, with the old house, it significantly increased the equity. Our house would have never been marketable because it was on a main street, and it would have never been marketable without the repairs that we did. But with those repairs, based on the comparables that the realtor gave us, we really gained about $25,000, and really it only cost us about $3,000 for those repairs. Now, let's flash forward to our current house, right? The current house, I can 100% assure you, based on the state that we bought the house, it was really traditional, still 80s wood all over the place, really like white walls that turned yellow. We turned it more modern. And if we were to put the house on the market today, I can guarantee you, because of the work that we put into it, we would have gained at least $40,000 to $50,000 in equity because of that. So totally worth doing that type of refinancing. Let's talk about 2024 now. What makes it so unique in 2024? Number one, we still have super high values. Even with the higher interest rates, the values are high. And the reason they're high is because no one's willing to sell their houses from 2020 to 2022, 2023, when they refinance into super low rates, right? And if they were to sell their house, they're gonna have to sell that super low rate into the higher rates. And because of that, that really helps with refinancing, okay? Number one, if it's a cash out refinancing, you're borrowing less loan to value. All right, what is loan to value? It is how much you're borrowing versus how much the house is worth. So we'll use this analogy, $500,000 and you borrow $400,000. That's 80% loan to value. So you're only using 80% of the value, you still have 20% equity. When you do that, it's helpful because you eliminate PMI, and that's another reason people refinance is to eliminate that private mortgage insurance that they had to take out when they first got the home. So if you had an FHA loan in the last couple of years and you're still paying private mortgage insurance, this should be something that you look into, right? Especially if you had a higher rate. You refinance into a rate term, conventional loan, now you've eliminated private mortgage insurance. So with the high values, it also benefits when it comes to cash out refinancing, and this is pretty obvious, right? So now that we have gained so much equity in the past, let's put that equity to work, right? Yes, the interest rates may be a little higher on the mortgages right now, but interest rates are high across the board. If you went out and you started shopping for a car recently, I'm sure you would have gotten sticker shock. If you go out and you look at your credit card statement, it's going to be sticker shock because everything has adjusted in the last couple years. So mortgage rates are adjusting, so is consumer debt. Now, eliminating that consumer debt has never been easier because now people have that equity in the house. So if you did not use that equity in the past, or even if you did use the equity in the past and you kept the loan to value low, there's still opportunities for you to refinance and it still makes sense. Now, one thing that we really need to keep in mind is that we are in an election year, so market dynamics really play a lot into this, right? And because it's an election year, regardless of the political party, the housing market has to stay strong, right? That is the true infrastructure and the backbone of the American economy. So in order to keep the interest rate strong, that gives the consumers more opportunities to take advantage of the refinances. So if we think back at the last couple of years, what happened with the interest rates? They were held down by the government so that we could continue to get out of our current high interest rates and utilize the resources of refinancing into that lower interest rate. So at this point, we're still kind of in that stage, right? The stage has been set. Like, there's new bills and laws that are being talked about for access to lower interest rates or grants for first-time home buyers and affordable housing. So that's kind of going to stimulate that part of it, of the economy. And at a certain point, we're going to see possibly interest rates falling. And when the interest rates start falling, what happens to the value of your home that you purchased while the rates are still high? That value increases. So we should always be looking at different opportunities to improve what we currently have. But this is definitely not a one-size-fits-all solution. So it's really important to understand your financial goals. And if you need some help, feel free to give us a call or click the link below. Let's talk about how refinancing could affect your credit score. So let's bust some myths. It is true that credit score definitely plays a lot into refinancing and even purchase financing. However, what you may actually see is when you're working with a loan officer, it's really important to get your credit pulled and have the loan officer actually look at the credit report, right? And what I mean by that, and I'll show it in an illustration, when we pull your credit report and we're looking at that credit report, I would say about 80% of the lenders have access to a what-if simulator, okay? On the what-if simulator, it's gonna really tell us, okay, based on what we see here, we can see improvement on your credit score if you do this, right? And that's why it's called what if. So if you pay down this credit card, your credit score will increase by 40 points. That's what I saw yesterday. A $97 pay down will increase this person's credit score by 40 points. He's gonna pay it off. He's gonna provide me the documentation that I need, and I'll do a rapid rescore, and we can increase that credit score. Now, why did I do that for a customer that I had recently? Number one, he purchased the home from me about a year ago. Okay, he used me for the financing. He knew that, I helped him get his credit score to where he had to be in order to purchase. However, with that being said, when we looked at it, current credit score was about 614, paid everything off, we're gonna get about 650, 660, right? Just that little difference will save my consumer over 1% on the closing cost. And on a $400,000 loan, that's a $4,000 savings. So that should be the first thing that you do. The second thing that you should do when you're refinancing and talking to your loan officer is we have to look at the strategy behind why you're refinancing. We have to see what are the best things to pay off. So once again, we go back to that simulator again and we say, okay, if we paid within your budget what you can pay to get the credit score to where it needs to be right now, let's see what we can do to really skyrocket the credit score after we do the refinance. So we looked at my customer's credit score and we said, okay, well, we're gonna pay this $97 bill down right now. In order to get to the next tier of credit, it is gonna require about $6,000. And we don't have that right now, right? So we strategically said, all right, we're gonna pay off these specific credit cards with the equity that you currently have. And because of that, that's really gonna save him and it's gonna increase his credit score in the long term. So it does provide him with a better solution for long-term financial health. Up next, I'm going to provide you with some of the best insider tips on how to secure the best refinance rates in 2024. So one question I always get asked is, how do you get the best interest rate, right? Interest rate has a lot of different moving parts and every loan is different. So let's look at the loan level pricing adjustment chart for this. We look at the Fannie Mae loan level pricing adjustment charts, and we are looking at this from the context of credit score and loan to value only. And when you look at this chart, you'll see what I'm talking about, and we'll have a link down below to show you the chart. Basically, what we see in here is depending on the loan to value, how much you borrow versus the loan, there's going to be some specific adjustments. So the adjustments start like this. Anything less than 30% only has a 3/8 adjustment, regardless of the credit score. Anything from 30 to 30.01 to 60% has a different loan level pricing adjustment. So as long as you stay below 60%, you're gonna have anywhere between 3/8 and 1 3/8. So 1 3/8 would be a 639 or below credit score, and anything greater than 780 will have that 0.375 adjustment. Then we go to the 60.01 to 70% mark. There's gonna be a larger range of adjustments. And then when you go up to 75.01 to 80%, that's where you're gonna see the major adjustments. So there's a lot of factors that come into this. So let's address this. Number one, I told you the values are high, so you're going to be able to access a lower loan to value. That's a good thing. Number two is credit scores, right? We look at the credit score now. We don't have to wait till the rescore comes back. You really have to work with your loan officer to see what the options are to do any potential rescore. And at that point, you save as much as you can. So with that customer that I talked about yesterday, they're accessing 60+% of the equity. So to go from a 614 to a 660, that is literally a 1 1/8 difference, okay? So 2.75% loan level pricing adjustment at the 660 mark, and then the 614 mark would have had a 3 3/8 adjustment. So when you see that type of adjustment, that 100% adjusts the interest rate that you get. So another myth that I want to cover before we go into securing the best interest rates is, does your credit score dip with hard pulls on your credit check? So this kind of goes hand in hand with shopping for your loan and shopping with different lenders, okay? So if you had your credit pulled April 1st, you have until April 30th, okay, to get all the credit pulls under your belt, especially for a mortgage. Now, all these credit pulls will count the same because you are shopping for a mortgage, and only really hard pulls count, right? So if you do soft pulls, the soft pull still gives us the data that we need. However, that data cannot be used to run the automated underwriting to see whether we're going to be doing the loan as an automated approval or a manual underwrite. At that point, you can kind of make your decision and shop around, okay? There's 3 types of lenders that you can shop with. The first type of lender is you can shop with a bank or direct lender. They're good for like the consumer that maybe has a lot of high net worth, and they go through that company and they may have a good old boy network type offer for you. And a lot of times those rates cannot be beat. The second type of institution that you can shop with is retail or a correspondent type organization. Banks and these retails are kind of the same. They're regulated. However, their regulation is different from wholesale mortgage brokers, and we'll kind of get into that. They will do the shopping for you. However, they have multi-level management, okay? They have a national manager, they have regional managers, they have branch managers, and then they have leaders and things like that. And how do you think they can successfully advertise without charging you a little more? Okay, you really have to think about that. So they can make double what mortgage brokers can make. Now, we go to the mortgage brokers who are wholesale, and there's 2 different types of mortgage brokers, okay, that you have to focus in on. The first type of wholesale mortgage broker is going to be the small mom and pop shop. They self-market. They do a lot of things in-house. They have their own processor. They may say, yeah, we have 8 choices we can shop with, or 15 choices they can shop with. Because if you think about it, they have about 1 to 10 loan officers, a team of 1 to maybe 5 different processors, and then they have to learn the systems of all of these different investors and how they take loans in and out. So they're good, they're still wholesale, and they're still going to be offering you a better rate than most retail places. However, you're going to be limited to options. Now, let's talk about the mega brokers now. Mega brokers really started poking their heads out like probably in the late 2010s, right? Whenever you wanted to go wholesale in the past, you would have had to got your broker license, business license, have an established location, so on and so forth, to open up your own broker shop. Now there are mega brokers, okay? Mega brokers are good because we can shop a bunch of investors. In my company, we can actually shop over 220 different investors. And what does that do for you, right? Now we have all these like, baby birds, and we'll look at them as the investors, right? They need to be fed the worm. So if one baby bird's not getting a lot of attention, how do they get attention? They have to offer pricing incentives. All of a sudden, they move to the top of the rate sheet and give you the best rate. So if you have a lot of time, always go to the mega brokers, have them shop it for you so they can shop 200 lenders, and there's 2 benefits. Number 1, we can get you the best price. Number 2, we can get you the best product because we want to look for the investors that have overlays and eliminate them if it's going to affect your closing. If one investor were to deny you, we can go to another investor and have them relook at it or get a second or third opinion or even a 5th opinion to get it done. And yes, that's what we've done. And we've had a lot of success closing loans of other mortgage brokers, other lenders, and turning that denial into an approval. And then finally, if speed matters, if you have to get something done, like I had a customer recently call me because they owed the IRS a bunch of money. In order for them to live comfortably, because their debt to income ratio was over 60-something%, right? In order for them to live comfortably, they had to get that debt to income ratio back down. And the only way that we could have done it was access the equity, paid off the remaining IRS tax liens, paid off some debts, and now there's thousands of dollars of savings every single month So we went from a over 60% debt to income ratio to 30%. Hear from those who have mastered refinancing, real stories and real savings. So I want to tell you about a story about two customers that we were recently notified about potential refinance savings. Both of these customers took out loans in the last 12 months. And when they took out the loans, they actually locked in when the rates were higher. And when I say higher, we're probably looking at like, sevens, mid sevens. All right. At this point, we were notified that they had an opportunity to be able to save some money with just a simple Streamline refinance. Okay, this is the most basic type of refinance that you can do with the Streamlines. These are great if you have the FHA or you have a VA loan. With these, there's a lot of savings and there's a lot less work and cost involved. Let's talk about how these work. So we'll just call this customer A and customer B. Customer A had a 7 3/8 interest rate, okay, with a loan amount of $504,000. When we looked at the difference between the interest rate of where they are and where we could put them at in the fives, high fives, they actually saved $433 a month. The closing cost that went into closing this loan was roughly about $7,000. So it only takes this customer 16.16 months to make up the difference in savings. So if we looked at this, we will then say the loan is 360 months. We are eliminating 16 months, and that's 344 months left. So if we're looking at a monthly savings of $433, we are now saving this customer $148,952. That's a huge savings. Now, let's look at customer B now. The loan ended up being right around $375,000, 7.5% interest rate. With a rate drop down to 6%, there's a $317 savings. This customer's closing cost was also around $7,000 because their credit score was a little lower. This consumer would make up the difference in 22 months. What I'm trying to show you here is there are a lot of potential savings out there. You really just need to talk to the loan officer to kind of like have them customize a action plan for you and see if it makes sense. Now, with this Streamline refinance, the benefits are going to be as follows. No appraisal needed, so we're not checking on the current value of the home. We're not re-verifying anything else on your credit report other than just the mortgage payment history. And if you've started noticing that, you're missing some payments and things like that, or you're falling behind on payments, then you really need to start looking at things before things start going 30 days late, because that's going to start affecting your credit score. The third thing that you really have to look at is the calculation we just did, right? We have to calculate what is the total cost of the loan? What is the monthly savings? How long does it take to make up the difference? And how long do you plan on living in the house? Both customer A and customer B are going to be living in this house for a long, long time. Now, if the rates drop down to 4%, would it be worth them refinancing again? Probably, because there's going to be even more additional savings. But in the long run, that value and that equity is still going to be there, and it's going to continue to increase. Now, customer B could really benefit by having some monthly savings relief, right? So with this Streamline refinance, they're going to get a couple different reliefs. Okay, number one, they're going to be able to skip 1 month of mortgage payment. So mortgage payments are always done in arrears. Okay, you close April 1st or you make your payment on April 1st, you're actually paying for the entire month of March. Or if you rent, and you make your April 1st payment, you're actually paying for living in the house in April. And then finally, the best part of this Streamline refinance process is it's very simple and it's very fast. So these consumer loans came in this week. We should have them done in about 14 days max. We're using the same title companies, so they're able to reissue that title work and save them some money there. And then their current escrow account is actually going to be refunded back to them. So they'll have a little bit of extra cash reserves because we're starting a brand new escrow account, and hence the higher closing costs. So if you're buzzing with questions and need personalized advice, we're here to guide you through your financial journey. Thank you all for watching. Please leave a like on this video, subscribe, and if there's anything I went over today that you still have questions about, let me know in the comments. I have resources and a link to my website in the description, and you can get in contact with me down there as well. Thank you all for watching. I'm David Zine Mortgage Guy, and I'm out.